Hello students, and welcome to the lecture on cash flows. We will cover various items as shown on this slide. We'll classify cash transactions into three categories of activities: operating, investing, or financing activities. We'll prepare the operating activities section of the statement of cash flows using what we call the indirect method. We'll prepare the investing activities section and the financing activities section of the statement of cash flows. We'll perform financial analysis using the statement of cash flows, and then we'll prepare the operating activities section of the statement of cash flows using the direct method. So in this section, we'll look at how the statement of cash flows is formatted. We'll classify cash transactions as operating, investing, or financing. Now, a statement of cash flows provides a summary of cash inflows and cash outflows during the reporting period. A cash inflow simply means cash received by the company during the reporting period. Similarly, a cash outflow is cash paid by the company during the period. The difference between cash inflows and cash outflows is called net cash flows, or the change in cash during the period. The three primary categories of cash flows are operating activities, investing activities, and financing activities. Now, operating activities include cash receipts and cash payments for transactions relating to revenue and expense activities. These are essentially the very same activities reported in the income statement. In other words, cash flows from operating activities include the elements of net income, but reported on a cash basis. Common examples of operating activities include the collection of cash from customers or the payment of cash for inventory purchases, salaries, and rent. Investing activities include cash transactions involving the purchase and sale of long-term assets and current investments. Companies periodically invest cash to replace or expand productive facilities such as buildings, land, and equipment. They might also invest in other assets such as stocks or bonds of other companies, with the exception of a return on those investments. Eventually, many of these assets are sold. The purchase and the sale of long-term assets and investments are common examples of investing activities. Financing activities are both inflows and outflows of cash resulting from the external financing of a business. A major portion of financing for many companies comes from external sources, specifically stockholders and lenders. Common financing activities are borrowing and repaying debt, issuing and repurchasing stock, and paying dividends. This slide represents the statement of cash flows for eGames, Inc. We'll use this statement as an example throughout this lecture, so don't be concerned about the details yet. That's what the rest of this lecture is going to be about. So this slide lists common cash receipts and cash payments for operating, investing, and financing activities. Now look at this slide carefully. You might want to even copy it. It will come in handy in solving a lot of homework problems at the end of this chapter and will help you on your quiz. Let's look at a few of the cash flow examples. So let's say we report interest and dividends received from investments with operating activities rather than investing activities. Similarly, we report interest paid on bonds or notes payable with operating activities rather than financing activities. Now, these are included in operating activities because each is a cash flow from an activity reported in the income statement: interest revenue, dividend revenue, and interest expense. Now, as we've talked about, operating activities are those we report in the income statement. On the other hand, we record dividends paid as a financing activity. Recall that dividends are not an expense, and therefore paying dividends has no effect on net income. The payment of dividends simply reduces cash and stockholders' equity, which is retained earnings. Some students misclassify dividends in preparing the statement of cash flows. Dividends received from other companies are included in operating activities, but dividends paid are included in financing activities. Now, while we prepare the income statement, the statement of stockholders' equity and the balance sheet directly from the adjusted trial balance, the accounts listed on the adjusted trial balance don't directly provide the cash inflows and cash outflows we report in the statement of cash flows. We have to rely on other sources of information to determine the amounts necessary to prepare the statement of cash flows. This slide outlines the three primary sources. First, the income statement provides information in determining cash flows from operating activities. The balance sheet is where we look at the changes in assets, liabilities, and stockholders' equity accounts from the end of the last period to the end of this period to find cash flows from operating, investing, and financing activities. And then we'll look at detailed accounting records because sometimes we need additional information from the accounting records to determine specific cash inflows or cash outflows for the period. Now, this slide summarizes the relationship of the income statement and balance sheet to the operating, investing, and financing sections in the statement of cash flows. So suppose a company borrows $200,000 in cash from a bank, issuing a long-term note payable for that amount. The firm reports this transaction in a statement of cash flows as a financing activity. Now suppose the company uses that cash to purchase new equipment. It reports this second transaction as an investing activity. But if instead of two separate transactions, the company acquired $200,000 of new equipment by issuing a $200,000 long-term note payable in a single transaction, then we'd exclude that transaction from the statement of cash flows because it didn't involve any cash. However, undertaking a significant investing activity and a significant financing activity as two parts of a single transaction does not lessen the value of reporting these activities. So for that reason, transactions that do not increase or decrease cash but that result in significant investing and financing activities are reported as non-cash activities, either directly after the cash flow statement or it could be also in a note to the financial statements. So transactions that do not increase or decrease cash but that result in significant investing and financing activities are reported as non-cash activities either directly after the cash flow statement or in a note to the financial statements. So examples of these are shown here. Purchase of long-term assets by issuing debt, purchase of long-term assets by issuing stock, or conversion of bonds payable into common stock. Having a better overall picture of the total investing and financing activities is important for investors and for creditors. We have two ways to determine and report cash flows from operating activities in a statement of cash flows by using what we call an indirect method or a direct method. The total net cash flows from operating activities are identical under both methods. The methods differ only in the presentation format for operating activities. We report investing, financing, and non-cash activities identical under both of the methods. Now, Using the indirect method, we begin with net income and then list adjustments to net income in order to arrive at operating cash flows. The indirect method is more popular because it generally is easier and less costly to prepare. In fact, nearly all major companies in the United States prepare the statement of cash flows using the indirect method. So for that reason, we're going to emphasize the indirect method. Now, using the direct method, we adjust the items on the income statement to directly show the cash inflows and outflows from operations such as cash received from customers and cash paid for inventory, salaries, rent, interest, and taxes. If a company decides to use the direct method to report operating activities, it must also report the indirect method either along with the statement of cash flows or in a separate note to the financial statements. Note that companies choose between the indirect and direct methods. The indirect method is less costly and is used by most companies. The direct method is more logical in that it presents inflows and outflows from operations. The investing and financing sections of the statement of cash flows are identical under both methods. Let's take a look at exercise 11.3. Analysis of an income statement, balance sheet, and additional information from the accounting records of Gadgets, Inc. reveals the following items: purchase of a patent, depreciation expense, decrease in accounts receivable, issuance of a notes payable, increase in inventory, collection of notes receivable, purchase of equipment, exchange of long-term assets, decrease in accounts payable, and payment of dividends. Now, our job is to indicate in which section of the statement of cash flows each of these items would be reported. Are they going to be in the operating activities, in the investing or financing activities, or a separate non-cash activities note? Now remember, operating activities generally include those items on the income statement. So, purchase of a patent is an investing activity similar to purchase of equipment. Depreciation would be operating. An increase or decrease in accounts receivable would be operating. Issuance of a notes payable will always be financing, a way in which they gather money for the company. Increase in inventory is operating. Collection of a notes receivable would be investing. Purchase of equipment, investing. Exchange of long-term assets, remember that's non-cash. They're exchanging. If it's a sale of a long-term asset, absolutely. There would be a gain piece and then a cash piece. But in this case, exchanging, it would be a non-cash activity. Decrease in accounts payable is operating. And payment of dividends is financing. It's important to note the items in financing would be debt, stock, and paying dividends. Let's check your understanding here. Which of the following would be included in the operating activities section of a statement of cash flows? The selling of a piece of equipment, the payment of dividends, the increase in the balance of accounts payable, and the issuance of common stock. C, the increase in the balance of accounts payable. Changes in current assets and current liabilities would be located in the operating activities section of a statement of cash flows. The sale of equipment would be the investing activities section, and the payment of dividends and issuance of stock would be in the financing activities section. Now, in this section, we're going to look at the steps involved in preparing the statement of cash flows and its basic format. Then we'll work through the steps in preparing the operating, investing, and financing sections of cash flows. Now, this slide is going to show steps in preparing the cash flows. The first step is to calculate the net cash flows from operating activities using information from the income statement and changes in current assets other than cash and current liabilities from the balance sheet. Then step 2, sorry about that guys, then step 2 is to determine the net cash flows from investing activities by looking at changes in long-term asset accounts from the balance sheet. Step 3 is going to be determining the net cash flows from financing activities by analyzing changes in long-term liabilities and stockholders' equity accounts from the balance sheet. And then step 4 is going to be combining the operating, the investing, and financing activities to make sure the total change from these 3 activities equal the amount of cash reported in the balance sheet this year versus last year, which would be the change in cash. So the income statement, the balance sheets, and the additional information for e-games are provided on the next few slides here. We're going to use this information to prepare the statement of cash flows following those 4 basic steps. This slide shows the income statement. Now this slide shows the first half of the balance sheets as of December 31st, 2018 and 2017. And this slide shows the final half of the balance sheets for December 31st of 2018 and 2017. Now, as you can see here on these, we show, for example, the receivables. In 2017, the 2017 accounts receivable had a balance of $20,000. In 2018, the accounts receivable had a balance of $27,000. So from 2017 to 2018, the accounts receivable account has increased by $7,000. Inventory, let's look at that. In 2017, the balance was $45,000. In 2018, the balance is $35,000. So inventory has decreased from 2017 to 2018. Look at land. Land was at $80,000. It's now at $70,000. Land has decreased $10,000 from 2017 to 2018. If you look at the liability section, accounts payable in 2017 is $27,000, and in 2018 is $22,000. What does that mean? It means the accounts payable has gone down $5,000. We used cash to pay $5,000 to reduce that. Therefore, we've used up cash between 2017 and 2018 on that specific account. Interest payable is the opposite. Interest payable was at $1,000. It's gone to $2,000. So that account has increased $1,000. Accounts payable, income taxes payable went from $7,000 to $5,000. It's decreased $2,000. Okay, so as we move on here, this slide's going to show us additional information in 2018 that's really important to our problem. We'll be referring to these slides as we prepare our statement of cash flows. We're going to have to reference this information as we go through this section here. So what we're going to do now is we're going to prepare the operating activities section of the statement of cash flows using the indirect method. So in preparing this statement, it's going to be helpful to set up a basic format. So this slide shows the last 3 lines of the statement of cash flows. And it includes amounts for the net increase or decrease in cash, cash at the beginning of the period, and cash at the end of the period. And we got this from eGain's balance sheet. So if we go back here to the balance sheet, do you see we have $62,000 is the cash now. In 2017 it was $48,000, which it has increased $14,000 from one period to the next. So you see here, there's an increase in cash of $14,000. Cash at the beginning of the period was $48,000. Cash at the end is $62,000. This has been derived from the balance sheet. Okay. The $14,000 change in the cash balance is going to be our check figure, which means the cash inflows and the cash outflows we identify must net to this amount. So the first step in preparing the statement of cash flows is to calculate net cash flows from operating activities using information from the income statement and changes in current assets other than cash and current liabilities from the balance sheet. Net income includes all revenue and expense activities reported on an accrual basis. So we report revenues when we provide goods and services to customers and expenses when we incur them, regardless of when the related cash flows occur. But what are the cash flows from those same revenue and expense activities? That amount equals net cash flows from operating activities. In other words, net cash flows from operating activities include all revenue and expense activities that are reported on a cash basis. So we have adjustments to net income in calculating operating cash flows, which include some non-cash items, some non-operating items, and some changes in current assets and current liabilities. Now, non-cash items are items that are included in revenues and expenses, but they never affect cash. The biggest one here would be amortization expense or depreciation expense. Non-operating items would include gains and losses on the sale of long-term assets that don't affect operating cash flow. Common examples are gains and losses from the sale of land, building, and equipment. And then changes in current assets and liabilities. Now, these changes are going to represent the non-cash portion of revenues and expenses. They occur when the cash flow for the year does not equal the related amount reported in the income statement. And we know, based on accrual method, that's going to happen all the time. So, for example, all sales to customers are reported as revenues in the income statement, but only cash collected from customers represents an operating cash inflow. The amount of revenue not collected in cash will equal the increase in accounts receivable. Let's take a look at an example. Hardware Suppliers reports net income of $165,000. Included in net income is a gain on the sale of land of $20,000. A comparison of this year's and last year's balance sheets reveals an increase in accounts receivable of $35,000, an increase in inventory of $20,000, and a decrease in accounts payable of $55,000. We're going to prepare the operating activities section of the statement of cash flows using the indirect method. Do you see a pattern in hardware suppliers' adjustments to net income to arrive at operating cash flows? What do you think about this? So we start with net income of $165,000. Then we're going to have to create some adjustments to reconcile net income to cash. So we had gain on the sale of land. The gain on the sale of land, there is an increase in accounts receivable, there's an increase in inventory, and there's a decrease in accounts payable. Now, if we start with our net income and we're trying to figure out how cash has been affected, the gain on the sale of land got added to our net income. So we're going to subtract that from our net income to arrive at a gain on, the cash flows. Our increase in accounts receivable, if you think about it, shows on the other side sales revenues. Now, we receive sales revenue by people paying cash or by people needing to still pay us in accounts receivable. When we have an increase in accounts receivable, that increased our revenues, but didn't necessarily affect our cash. So we're going to, when we have an increase in accounts receivable, subtract that from our net income to come up with our net cash flows. When we have an increase in inventory, we're going to also subtract that from our net income. And when we have a decrease in accounts payable, we're going to subtract that also. If you think about a decrease in accounts payable, the first year you had $75,000 of accounts payable. In this year, it's down to $20,000. It made a difference of $55,000. How did that decrease happen? The decrease happened by using cash to pay down accounts payable. So if we start with our net income and then adjust based on various effects in the balance sheet, all of the adjustments are subtracted from net income to arrive at our net operating cash flows. This is a natural occurrence in the data, or it could simply imply that management may be using some of these items to help overstate net income. So as you see, I don't know, that's a possibility, but gain on land definitely increases your net income, but that's not necessarily affecting our cash. Here's a question for you. Which of the following would be included as an adjustment to net income in the operating activities section of a statement of cash flows using the indirect method? Would it be a depreciation expense, purchase of a truck, issuance of common stock, or payment of cash dividends? Remember, guys, a truck is investing. Issuance of common stock is financing, and paying cash dividends are financing. Depreciation would be an adjustment into the operating activities. Now let's just think about this for a minute. Depreciation is an expense we use that reduces our net income, but it really has no play with cash at all. So when there's depreciation, we generally are going to add that back as an adjustment because that net income is not being affected by cash. Now, this slide provides a summary of the adjustments we make to convert net income to cash flows from its operating activities. The first two items represent non-cash expenses. The second two items are non-operating items, and the final four are changes in current assets and current liabilities. This is a really important slide for you to keep a copy of. This helps you understand from one period to the next how you adjust your net income and if you increase or decrease to come to cash flows from operating based on various increase or decrease in the account balances. So something really important to have beside you, so when you are working through these cash flow statements, you understand if from one year to the next there's a decrease in a current asset, you're going to add that as an adjustment. If there's an increase in a current asset, you're going to subtract that adjustment. This is really helpful for you. Now, eGames reports net income of $42,000 and depreciation expense of $9,000 in its statement. Because depreciation expense reduces net income by $9,000, eGames is going to add the $9,000 back to net income in arriving at net cash flows from operations. This slide shows how eGames reports depreciation expense in the statement of cash flows under the indirect method. Now, next, we're going to adjust for gains and losses that don't affect operating cash flows. These are going to be adjustments for non-operating effects, such as a loss on the sale of land. Losses on the sale of long-term assets decrease net income, while gains on the sale of those assets increase net income. eGames reports a $4,000 loss on the sale of land in its income statement. Now, the loss is not an operating cash flow or cash outflow. The actual sale of land is an investing activity we'll talk about later, but yet we subtracted the $4,000 loss in the income statement in determining net income. So we have to look at this and add it back in order to eliminate this non-operating component of net income. This slide shows how eGames adds back the loss on the sale of land to net income in arriving at net cash flows from operating activities. Again, think it through. Because we had a loss on the land, that decreased our net income. So to flow from net income to cash flows from operating activities, since that decreased our net income, we need to add it back. A common mistake many students are unsure about is whether you add or subtract a loss on the sale of assets. Just remember that a loss is like an expense. They reduce net income. Treat a loss on the sale of assets like depreciation expense and add it back to net income. A gain on the sale of a long-term asset is the opposite of an expense, so we subtract it from net income to arrive at net cash flows from operating activities. For components of net income that increase or decrease cash, but by an amount different from that reported in the income statement, we adjust net income for changes in the balances of related balance sheet accounts to convert the effects of those items to a cash basis. To convert other income statement components from accrual to cash basis, we adjust net income for changes in all current assets other than cash and current liabilities. So eGames accounts receivable increased $7,000 during the year. It was at $20,000 in 2017, and it went up to $27,000 in 2018. So the $7,000 increase represents $7,000 of sales that eGames reported as part of net income, but it didn't result in operating cash flows. Therefore, to adjust net income, the accrual basis, to operating cash flows, which is a cash basis, we need to eliminate that $7,000 from net income, as shown in this slide. Now, eGames' inventory balance decreased by $10,000 during the year. This tells us that the company sold $10,000 of inventory that it didn't replace. This $10,000 is reported as cost of goods sold, which is an expense on the income statement, which reduces net income. But it has no effect on cash. So to adjust for cash being greater by $10,000, we add the decrease in inventory to net income, as you see on this slide. Remember, expenses we add back. eGames' prepaid rent increased $2,000 during the year. The company paid $2,000 cash for an asset for which there's no corresponding expense. So in other words, the cash outflow for prepaid rent made cash decrease by $2,000, but net income wasn't affected at all because it wasn't an expense, it was an asset. So to adjust for cash being lower by $2,000, we're going to subtract the increase in prepaid rent from net income, as shown here. Now, eGames' accounts payable decreased $5,000 during the year. The decrease in accounts payable indicates the company paid $5,000 worth of cash to reduce its liability, its accounts payable, but it reported no corresponding expense during the period. In other words, the cash outflow to reduce that accounts payable made cash decrease by $5,000, but net income remained unaffected. So to adjust for cash being lower by $5,000, we need to subtract the decrease in accounts payable from net income, as shown here. eGames' interest payable increased $1,000 during the year. An increase in interest payable indicates that the company recorded interest expense of $1,000 for which it did not pay cash. In other words, the $1,000 increase in interest payable reduced net income because it's interest expense, but has no effect on cash. So to adjust for cash being greater by $1,000, we add the increase in interest payable to net income, as shown here. eGames' income tax payable decreased $2,000 during the year. The decrease in an income tax payable indicates the company paid $2,000 cash to reduce its liability, its income tax payable, but reported no corresponding expense during the period. So in other words, the cash outflow to reduce income tax payable caused cash to decrease by $2,000, but net income was unaffected. To adjust for cash being lower by $2,000, we subtract the decrease in income tax payable from net income. Now this slide shows the adjustment and calculates total net cash flows from operating activities of $50,000. Remember, using the indirect method, we'll always start with net income and then adjust this number for revenues and expense items that don't affect cash. We'll adjust for gains and losses that don't affect operating cash flows and changes in current assets and in current liabilities. Let's look at a problem. Portions of the financial statements for Peach Computer are provided below. So in the previous slide you see the income statement, and this slide there's the balance sheet. Prepare the operating activities section of the statement of cash flows for Peach Computer using the indirect method. Remember, we're always going to start with net income. So net income of $130 came from the income statement of $130. That's the first thing. Then what we're going to do is we're going to create some adjustments. If we look at the income statement, we see depreciation expense, which reduces net income but does not have any cash effect. So we are going to adjust to reconcile net income to net cash flows. Since depreciation expense of $60,000 reduced our net income but had no cash effect, consequence, we're going to add depreciation expense back. Next, we're going to look at the changes in assets and liabilities. As you see here, we never talk about cash, but accounts receivable went from $54,000 in 2017 to $46,000 in 2018. It decreased by $8,000. When we have a decrease in a current asset, we're going to add it back. When we have an increase in a current asset, we're going to subtract it. So as you see, inventory went from $60,000 in 2017 to $85,000 in 2018. Because it increased, we're going to subtract it. Remember, decreases get added, increases get subtracted. So you see the decrease in inventory, the increase in inventory gets subtracted. The decrease in accounts receivable gets added. You also see a decrease in prepaid rent. It went from $7,000 to $4,000. So that will be added as shown here, decrease in prepaid rent. Now the liabilities we're going to do the opposite of. When a liability is increased, we're going to add it. When it's decreased, we're going to subtract it. So the accounts payable went from $42,000 to $55,000. As you see, it was an increase of $13,000 we're going to add. The decrease in income tax payable from 15 to 6, we're going to subtract. Remember, we used cash to go from $15,000 to $6,000. Therefore, we have to subtract cash because we used that money, that cash. So we start with a net income of $130. We add and subtract to come up with net cash flows from operating activities of $180,000. Let's look at a question here. Which of the following items would be added back to net income in the operating activities section of a statement of cash flows using the indirect method? Would it be a gain on sale of piece of equipment? No, remember that gain increases our net income, therefore we'd want to subtract it. Payment of dividends? No, that's a financing. Increase in the balance of accounts payable or increase in the balance of accounts receivable. When assets increase, we subtract. When assets decrease, we add. The opposite is true for liabilities. When liabilities increase, we add. And when liabilities decrease, we subtract. Increases to current liabilities are added back to net income in the operating section of a statement of cash flows to arrive at the net cash flows from operating activities.